What if one of the biggest investment stories of the next decade isn't hiding in artificial intelligence, cryptocurrency, or even the stock market, but in a metal that has quietly existed for thousands of years? While millions of investors spend their days chasing headlines, watching stock prices, and reacting to every market swing, some of the world's largest investment firms are asking a much deeper question: what is changing beneath the surface of the global economy? History has a way of repeating itself, and the biggest opportunities rarely begin with excitement, they begin with silence. Before oil became one of the world's most strategic resources, few people paid attention. Before semiconductors transformed the global economy, they were simply components hidden inside electronic devices. Before artificial intelligence became one of the most talked about technologies on Earth, it was a niche field followed by only a handful of researchers. The most significant shifts often begin long before the headlines arrive, and according to many analysts, silver may be entering a similar moment. At first glance, silver doesn't seem extraordinary. It isn't the newest technology, it doesn't dominate financial news every day, and its price has spent years moving through cycles of optimism and disappointment. Yet beneath that seemingly ordinary surface, a remarkable story is unfolding, one driven by forces much larger than a single commodity. It's a story involving central banks, inflation, government debt, renewable energy, artificial intelligence, semiconductor manufacturing, and the changing balance of the global economy. Individually, these trends may appear unrelated, but together they reveal a picture that few investors fully appreciate. Silver occupies a unique position in the modern world because it is both an ancient store of value and a critical industrial resource. It has served as money throughout history while becoming essential to the technologies shaping the future. Very few assets exist at the intersection of financial uncertainty and industrial innovation. Silver does, and that is precisely why it has captured the attention of economists, market strategists, and institutional investors around the world. What makes this story even more intriguing is that the world's largest investors rarely announce what they're studying before the rest of the market notices. They don't wait for headlines to confirm a trend. Instead, they spend months, sometimes years, researching economic conditions, evaluating risk, and identifying long-term shifts before the broader investing public begins asking questions. Their goal isn't to predict the future with perfect accuracy, because no one can. Their goal is to recognize change while it's still taking shape. Today, many of those changes appear to converge around one surprisingly familiar asset: silver. Not because it's guaranteed to outperform every other investment, and not because it offers certainty in an uncertain world, but because it reflects something much bigger than its own price. It reflects the direction of manufacturing, the future of energy, the health of the global economy, the confidence investors place in currencies, and the decisions governments and central banks are making today that could shape markets for years to come. So the question isn't simply whether silver will rise or fall. The deeper question is this: what do billion-dollar investors see that the rest of the market may still be overlooking? Because if history has taught us anything, it's that by the time everyone is talking about an opportunity, the biggest advantage often belongs to those who recognized the signal long before it became obvious. And that is exactly the mystery we're about to explore. If you ask the average investor why silver matters, the answer usually begins with a price chart. They'll point to today's market, yesterday's rally, last week's decline, or the latest headline predicting that silver is either about to soar or collapse. For most retail investors, the price comes first and everything else comes second. But on Wall Street, where billions of dollars move through pension funds, hedge funds, sovereign wealth funds, and institutional asset managers, the process works very differently. Professional investors rarely begin by asking, "Where is silver trading today?" Instead, they ask a far more important question: why is the market moving in the first place? They understand something that separates successful long-term investing from emotional speculation: price is the result, not the cause. Every movement in the market is the consequence of something deeper: a shift in monetary policy, a change in inflation expectations, a technological breakthrough, a disruption in global supply chains, or a change in investor confidence. These are the forces institutions study every single day. While millions of retail investors spend hours refreshing price charts, institutional research teams are reading Federal Reserve speeches, analyzing Treasury yields, studying manufacturing data, tracking mining production, and evaluating capital flows across the global economy. Their objective isn't to predict tomorrow's price, it's to understand tomorrow's environment. Because by the time a trend becomes obvious on a chart, the smartest money has often been studying it for months, or even years. History demonstrates this pattern again and again. The biggest investment opportunities rarely begin with dramatic headlines, they begin quietly. Before the technology boom of the 1990s, institutional investors were already studying the rapid growth of personal computing. Before electric vehicles became mainstream, major investment firms were researching battery supply chains and the minerals needed to support them. Before artificial intelligence dominated financial news, venture capital firms and technology investors had spent years funding research and infrastructure. The same principle applies to commodities. Professional investors don't buy because everyone else is excited. They buy when they believe the long-term fundamentals are changing. That difference explains why institutions and retail investors often behave in completely different ways. Retail investors tend to react, while institutional investors try to prepare. Retail investors ask, what happened today? Institutional investors ask, what is likely to happen over the next 5 years? That difference in perspective changes everything. Instead of chasing momentum, institutions focus on probabilities. Instead of reacting to emotion, they build scenarios. Instead of making decisions based on social media trends or television headlines, they rely on research, data, and disciplined risk management. Every investment begins with one simple question: what is changing beneath the surface that the market has not fully recognized yet? That question has become increasingly important when it comes to silver. For years, silver lived in the shadow of gold. Gold dominated discussions about inflation, central banks, and wealth preservation, while silver was often viewed as gold's smaller, more volatile cousin. But that perception has gradually begun to change. Today, silver occupies a unique position unlike almost any other commodity because it serves two completely different roles at the same time. First, it remains a precious metal with a long monetary history. For thousands of years, civilizations recognized silver as a store of value and a medium of exchange. Its scarcity, durability, and universal acceptance gave it lasting importance long before modern financial markets existed. Second, silver has become an essential industrial material. It plays a critical role in solar panels, semiconductors, advanced electronics, medical technology, electric vehicles, aerospace systems, telecommunications, and the rapidly expanding infrastructure supporting artificial intelligence. Few assets bridge the gap between ancient monetary history and cutting-edge technology, but silver does. That dual identity has returned it to the radar of institutional investors, not because anyone knows exactly where prices will go next, since no serious investor can make that promise, but because silver is increasingly connected to some of the most powerful long-term trends shaping the global economy. Governments are investing billions in energy infrastructure. Technology companies continue building larger and more advanced data centers. Manufacturers are expanding production of electric vehicles and renewable energy systems. At the same time, investors continue debating inflation, government debt, interest rates, and the future purchasing power of major currencies. Each of these developments influences a different part of silver's demand story. Some affect industrial consumption, while others influence investment demand. Together, they create a market that is far more complex and potentially far more significant than many investors realize. This is why silver has quietly moved back into conversations on Wall Street. Not because institutions are chasing excitement or expecting certainty, but because they recognize when multiple long-term trends begin converging around a single asset. History suggests that these moments deserve careful attention, not blind optimism or fear, but thoughtful analysis. The greatest investors understand that markets rarely reward those who react first, they often reward those who understand first. And perhaps that is the hidden signal. Silver's story isn't simply about the metal itself. It's about what the metal reveals. It reflects changing industrial priorities, evolving monetary conditions, and shifting investor expectations. Sometimes, the most important signal in financial markets isn't the price everyone can see. It's the quiet change in the underlying forces that only a few are watching, until everyone else finally notices. If there is one lesson that financial history teaches over and over again, it is this: markets do not exist in isolation. The price of silver is not determined by supply and demand alone. Instead, it is influenced by a much larger financial ecosystem shaped by central banks, government policies, inflation, interest rates, and the strength of the world's reserve currency. This is the environment that institutional investors study every day. Before they invest billions of dollars into any asset, they first ask a simple question: what kind of monetary environment are we entering? The answer often begins with inflation. Inflation is more than just rising prices at the grocery store or higher fuel costs. At its core, it represents the gradual decline in purchasing power. When inflation accelerates, each dollar buys a little less than it did before. For households, that means a higher cost of living. For businesses, it means rising operating expenses. For investors, however, it raises an entirely different question: how do you protect purchasing power over the long term? Throughout history, investors have looked for assets they believe can help preserve value during periods of persistent inflation. Real estate, certain commodities, shares of strong businesses, and for centuries, precious metals have all been considered potential stores of value. Not because these assets eliminate risk, no investment does, but because they are often viewed as alternatives when confidence in paper currencies begins to weaken. This is one reason silver attracts attention whenever inflation becomes part of the economic conversation. Yet inflation is only one piece of a much larger puzzle. The next piece is the institution that influences global financial markets more than almost any other, the Federal Reserve. Often referred to simply as the Fed, the Federal Reserve plays a central role in managing monetary policy in the United States. Its decisions influence borrowing costs, financial conditions, market liquidity, and investor expectations around the world. When the Federal Reserve raises interest rates, borrowing becomes more expensive. Consumers may spend less, businesses may delay expansion, and economic growth can slow. The goal is to reduce inflation by cooling demand across the economy. When the Federal Reserve lowers interest rates, the opposite often occurs. Borrowing becomes more affordable, investment increases, and economic activity may accelerate. These policy decisions ripple through every major financial market. Stocks respond. Bonds respond. Currencies respond. And precious metals often respond as well. But professional investors understand something that is frequently overlooked. Markets don't simply react to what the Federal Reserve does, they react to what investors believe the Federal Reserve will do next. Financial markets are forward-looking. Prices reflect expectations as much as current reality. If investors believe inflation is easing and interest rate cuts could eventually follow, markets may begin adjusting long before any official announcement is made. Likewise, if inflation proves more persistent than expected, investors may anticipate tighter monetary policy for longer than previously assumed. That shift in expectations alone can influence everything from bond yields to currency values. This is why institutional investors listen carefully not only to interest rate decisions but also to every speech, press conference, and policy statement from Federal Reserve officials. Sometimes a single sentence changes market expectations, and in financial markets, expectations can be just as powerful as actions. Interest rates also influence another important concept known as the opportunity cost of holding precious metals. Unlike bonds or savings accounts, silver does not generate income. It doesn't pay interest or distribute dividends. Its value depends primarily on market demand and price appreciation. When interest rates are high, income-producing assets often become more attractive. When rates begin falling, that advantage can diminish, making alternative assets more competitive within diversified portfolios. However, history reminds us that this relationship is rarely straightforward. There have been periods when precious metals performed well despite rising interest rates because investors were more concerned about inflation, financial stability, or long-term economic uncertainty than short-term yields. Context matters, and institutional investors understand that no single indicator tells the entire story. Which brings us to another issue receiving increasing attention in financial circles: government debt. Over the past several decades, government borrowing has expanded dramatically across many advanced economies. Debt itself is not unusual. Governments routinely borrow to finance infrastructure, public services, and economic stimulus. The important question is not whether debt exists, but whether investors remain confident that debt levels are sustainable over the long term. As debt grows, governments face rising interest expenses. Higher borrowing costs can place additional pressure on public finances, especially during periods of elevated interest rates when refinancing existing debt becomes more expensive. Institutional investors closely monitor these developments because fiscal conditions influence economic growth, investor confidence, and long-term monetary policy. They are not looking for immediate conclusions. Instead, they are evaluating probabilities. Can economic growth outpace debt accumulation? Will inflation gradually reduce the real value of outstanding debt? Could future policy changes alter the investment landscape? These are the questions shaping billion-dollar portfolio decisions. Finally, there is the US dollar. As the world's primary reserve currency, the dollar occupies a unique position in the global financial system. International trade, commodity pricing, sovereign reserves, and cross-border investment all depend heavily on its stability. Because silver is typically priced in US dollars, changes in the currency can influence global demand. When the dollar strengthens, silver often becomes more expensive for buyers using other currencies. When the dollar weakens, silver may become relatively more affordable in international markets. However, the relationship is not always perfect. Economic growth, industrial demand, investor sentiment, and geopolitical developments all interact with currency movements in complex ways. That is precisely why institutional investors never rely on a single indicator. Instead, they analyze the entire monetary landscape: inflation, Federal Reserve policy, interest rates, government debt, Treasury markets, and the US dollar. Each represents one piece of a much larger picture. And when those pieces begin changing at the same time, experienced investors pay close attention. While headlines focus on today's market movements, institutional investors are often studying the financial environment that could shape markets not just for the next few weeks, but for years to come. Every commodity has a story. Oil powers transportation. Natural gas generates electricity. Copper builds cities. Lithium stores energy. Gold has long been associated with wealth preservation. But silver is different. It doesn't fit neatly into a single category. Instead, it occupies a unique position that very few assets can claim. It is both a precious metal and an industrial metal, serving as money for thousands of years while also becoming an essential component of some of the world's most advanced technologies. That combination is what makes silver so fascinating and one of the primary reasons institutional investors continue paying close attention to it. To understand why, we need to look back long before modern financial markets existed. For much of recorded history, silver wasn't simply another commodity, it was money. Ancient civilizations traded with silver coins. Empires stored silver in their treasuries. Merchants measured wealth in silver long before the invention of paper currency. From the Roman Empire to Imperial China and the Spanish colonial trade routes, silver connected economies across continents. Its value wasn't based on quarterly earnings or interest rates but on scarcity, durability, divisibility, and universal acceptance. For centuries, silver represented trust. Even after nations gradually transitioned away from precious metal-backed monetary systems, silver retained its reputation as a tangible asset outside the traditional financial system. That historical legacy still matters today. During periods of economic uncertainty, inflation concerns, or financial instability, investors often revisit assets that have preserved purchasing power across generations, and silver remains part of that conversation. But history alone is not what makes silver unique. If silver were only a monetary metal, its investment case would look very different. Instead, it has quietly become one of the most important industrial materials in the modern economy. Unlike gold, which is primarily held for investment, jewelry, and central bank reserves, a significant portion of silver is consumed in manufacturing. That distinction changes everything. Silver possesses an extraordinary combination of physical properties. It is the most electrically conductive metal known, the most thermally conductive, and one of the most reflective materials on Earth. These characteristics make it exceptionally valuable in industries where efficiency, reliability, and precision matter. As technology has advanced, silver's industrial role has expanded alongside it. One of the clearest examples is solar energy. Modern photovoltaic panels rely on silver to conduct electricity generated from sunlight. As governments and private companies invest billions of dollars in renewable energy infrastructure, demand for high-performance materials continues to grow. Every new solar installation represents another application where silver plays a critical role. Another rapidly expanding industry is electric vehicles. The average electric vehicle contains more silver than many traditional gasoline-powered cars because of its complex electrical systems, advanced sensors, battery management components, and high-performance electronics. As global automakers continue increasing EV production, manufacturers are paying close attention to the materials required to support that transition. Then there is artificial intelligence. When people think about AI, they usually imagine software, algorithms, and powerful language models. What many overlook is the enormous physical infrastructure required to make AI possible. Every AI model runs inside massive data centers filled with servers, processors, networking equipment, cooling systems, and high-speed electrical components. Those systems require highly conductive materials to maximize performance and reliability, and silver plays an important role in many of those advanced electronic applications. The same is true for semiconductor manufacturing. Modern computer chips contain billions of microscopic transistors operating at extraordinary speeds. Producing these chips requires advanced manufacturing equipment and highly specialized materials. Silver is used in numerous electronic contacts, circuit components, and industrial processes because of its exceptional conductivity. As nations invest heavily in domestic semiconductor production, demand for critical industrial materials becomes increasingly important. This illustrates why silver occupies such a unique position. Its future is influenced by two completely different sources of demand: investment demand and industrial demand. If inflation concerns increase, investors may allocate capital toward precious metals. If technological innovation accelerates, manufacturers may require more silver for production. Both forces can exist simultaneously, and very few commodities benefit from that kind of dual demand structure. Oil depends primarily on energy consumption. Copper depends largely on construction and infrastructure. Gold depends mostly on investment and central bank demand. Silver stands at the intersection of multiple economic forces. That does not mean higher demand automatically leads to higher prices. Markets are rarely that simple. Mining production changes. Recycling increases. Manufacturing cycles fluctuate. Economic slowdowns reduce industrial activity. Investor sentiment shifts. Supply and demand are constantly evolving. Institutional investors understand these complexities. They do not assume every positive trend guarantees a positive outcome. Instead, they evaluate probabilities. They study whether industrial demand is growing faster than supply, analyze mining investment and future production capacity, examine technological adoption rates, and compare long-term structural trends with short-term market conditions. Most importantly, they ask whether today's market fully reflects tomorrow's realities. This is why silver has gradually returned to Wall Street's radar, not because it is a speculative trade or because it promises extraordinary returns, but because it sits at the crossroads of some of the most significant transformations shaping the global economy. The transition toward renewable energy, the rapid expansion of artificial intelligence, the race to build advanced semiconductor manufacturing, the electrification of transportation, and the ongoing debate surrounding inflation, monetary policy, and long-term purchasing power all contribute to silver's growing importance. Each trend tells only part of the story. Together, they create something much more compelling. Silver is no longer simply a metal associated with coins and jewelry. It has become a strategic material supporting the technologies of the future while retaining the historical qualities that made it valuable for thousands of years. That combination is exceptionally rare, and history has shown that when an asset connects the past with the future, investors tend to pay attention. Sometimes the most important opportunities are not created by entirely new ideas. Sometimes they emerge when an ancient asset finds an entirely new purpose in a rapidly changing world, and that may be exactly what makes silver unlike any other commodity on Earth. When most people think about investing, they imagine stock charts, earnings reports, or the latest financial headlines flashing across television screens. But inside the world's largest investment firms, the conversation is often very different. Portfolio managers responsible for billions of dollars are rarely asking, which asset will be the hottest next month? Instead, they're asking a far more important question: what signals are telling us that the financial environment is changing? Institutions understand a simple truth: markets often move long before the headlines explain why. Their goal is not to predict every market move with perfect accuracy, but to recognize the conditions that increase the probability of one outcome over another. And when it comes to silver, several key indicators continue attracting institutional attention. The first is the Treasury market. Although it receives far less media coverage than the stock market, many professional investors consider the U.S. Treasury market to be one of the most important markets in the world. Treasury securities influence borrowing costs across the global economy, affecting mortgage rates, corporate loans, government financing, business investment, and consumer spending. Virtually every major asset class is influenced by movements in Treasury yields. That is why institutional investors monitor this market every day. But they don't simply ask whether yields are rising or falling, they ask why. Are yields increasing because economic growth is strengthening? Because inflation expectations are rising? Because governments are issuing more debt? Or because investors are demanding greater compensation for uncertainty? The answer changes how every other market is interpreted. This leads to another critical concept that professional investors watch closely: real interest rates. Unlike nominal interest rates, real interest rates account for inflation. In simple terms, they measure how much purchasing power an investor gains after inflation is considered. For precious metals, this relationship has historically been important. When real interest rates are relatively attractive, income-producing assets may become more competitive. When real returns become less attractive, investors often reassess where capital should be allocated. Institutional investors rarely focus on one number alone. Instead, they compare inflation trends, bond yields, and monetary policy together to understand the broader investment landscape. They know silver does not exist in isolation. It competes for capital alongside stocks, bonds, real estate, commodities, and cash. The next signal institutions monitor is something far less visible to the average investor: supply. Many people assume that if demand rises, production simply increases to meet it. In reality, mining is one of the most capital-intensive and time-consuming industries in the world. Discovering economically viable deposits can take years. Permitting new projects often requires extensive environmental reviews. Developing a mine demands enormous investment in equipment, infrastructure, skilled labor, and logistics. Even after approval, bringing a new mine into full production may take a decade or longer. That means supply cannot always respond quickly when demand changes. Institutional investors understand this better than anyone. They study mining company reports, exploration budgets, ore grades, production forecasts, recycling trends, political risks in producing regions, and long-term investment in future capacity. Their objective is not to predict shortages but to understand whether future supply is likely to keep pace with future demand. That distinction matters because commodity markets often experience periods where demand evolves faster than production capacity. Whether that occurs with silver remains uncertain, but it is precisely the type of question that institutional research teams continually evaluate. Another factor receiving growing attention is global capital flow. Capital is constantly moving around the world. Money shifts between equities, government bonds, corporate debt, commodities, currencies, and alternative assets depending on how investors view risk and opportunity. When confidence in economic growth is strong, capital often flows toward growth-oriented investments. When uncertainty rises, investors may seek diversification and assets perceived as defensive. Large institutions don't simply analyze individual markets, they examine where global money is moving. They monitor pension funds, insurance companies, central bank reserve management, sovereign wealth funds, exchange-traded fund activity, currency markets, and international investment flows. Every movement tells part of a much larger story because financial markets are deeply interconnected. A change in bond yields can influence currencies. Currency movements can affect commodity prices. Commodity prices can influence inflation. Inflation expectations can alter central bank policy. And those policy decisions eventually reshape global capital allocation. This interconnected system is what professional investors attempt to understand. They are not searching for certainty, they are building probability-based scenarios. They recognize that successful investing is rarely about finding one perfect indicator. It is about assembling dozens of signals into one coherent picture. That mindset is one of the biggest differences between institutional investors and everyone else. Retail investors often search for the next prediction. Institutions search for the next trend. Retail investors react to market moves. Institutions analyze the conditions that created those moves. Retail investors ask, where is silver trading today? Institutional investors ask, what is changing beneath the surface that could influence silver over the next 5 years? That difference in thinking explains why billion-dollar investors spend far more time studying Treasury yields, real interest rates, supply dynamics, and global capital flows than they do watching hourly price charts. History has demonstrated repeatedly that by the time a trend becomes obvious to everyone, much of the opportunity and much of the risk has already been priced into the market. The greatest advantage rarely comes from reacting faster than everyone else. It comes from understanding the bigger picture before everyone else does. And that is exactly why silver continues appearing on the research desks of some of the world's largest investment firms. Not because they know the future, but because they recognize when multiple long-term signals begin pointing in the same direction. In investing, those moments never guarantee success, but they almost always deserve attention. No matter how convincing an investment story may seem, one principle has guided the world's most successful investors for generations: the future is never certain. Markets are shaped by millions of decisions made every day by governments, businesses, central banks, institutions, and individual investors. Unexpected events can change the direction of an economy almost overnight. That is why professional investors rarely rely on a single prediction. Instead, they prepare for multiple possibilities. Rather than asking, what will happen, they ask, what could happen? When it comes to silver, three broad scenarios help frame the discussion. None of them is guaranteed, and each depends on how economic conditions evolve over the coming years. In the bullish scenario, several powerful trends continue moving in the same direction. Industrial demand keeps growing as artificial intelligence, electric vehicles, renewable energy, and semiconductor manufacturing expand across the global economy. Governments continue investing heavily in energy infrastructure, while technology companies build more data centers and advanced manufacturing facilities. At the same time, inflation proves more persistent than expected, encouraging investors to seek assets that may help preserve purchasing power. If interest rates gradually decline while industrial demand remains strong, investment demand and industrial demand could reinforce one another. In that environment, silver would benefit from both sides of its unique identity, as a precious metal valued during periods of monetary uncertainty and as a strategic industrial resource essential to modern technology. This is the outcome many long-term silver investors believe offers the greatest upside potential, although no one can predict its timing, duration, or magnitude with certainty. The neutral scenario is far less dramatic but perhaps just as realistic. Economic growth continues, though at a moderate pace. Inflation gradually moves closer to central bank targets, interest rates stabilize, and industrial demand remains healthy without accelerating dramatically. Mining production and recycling continue supplying enough silver to satisfy most of that demand, preventing major shortages from developing. In this environment, silver may experience periods of strength followed by periods of consolidation, reflecting a market that remains relatively balanced between buyers and sellers. Rather than producing spectacular price moves, the market would likely be driven by gradual structural changes unfolding over many years. History reminds us that not every commodity cycle ends with explosive rallies. Sometimes prices simply adjust over time as supply and demand evolve together. For disciplined long-term investors, such an environment may require patience rather than excitement. The bearish scenario deserves equal consideration because responsible investing requires acknowledging risks as well as opportunities. A global economic slowdown could reduce manufacturing activity and weaken industrial demand. Renewable energy projects might expand more slowly than expected, electric vehicle adoption could lose momentum, and investment in advanced technologies could temporarily moderate. At the same time, inflation could decline more rapidly than anticipated, allowing central banks to maintain confidence in the financial system while keeping real interest rates relatively attractive. If investors become more comfortable holding traditional income-producing financial assets, demand for precious metals could soften. Combined with stable or expanding mine production, these conditions could place downward pressure on silver prices for an extended period. Such an outcome would demonstrate that even the strongest long-term investment narratives can experience prolonged periods of disappointment before their underlying trends eventually reassert themselves. That is precisely why institutional investors avoid becoming emotionally attached to any single forecast. They build diversified portfolios designed to adapt as economic conditions change. In investing, long-term success rarely comes from making one perfect prediction. It comes from preparing for multiple possible futures while managing risk with discipline and consistency. Silver's next chapter has not yet been written. It could unfold through sustained strength, steady stability, or temporary weakness. The responsible investor recognizes all three possibilities because understanding uncertainty is often far more valuable than believing in certainty. Every generation believes its challenges are unlike anything that came before. The headlines change, technologies evolve, new industries emerge, and old assumptions disappear. Yet beneath every financial cycle, one truth remains remarkably consistent: markets reward those who prepare, not those who panic. Throughout this documentary, we've explored why silver has quietly returned to the attention of economists, institutional investors, and long-term market observers. Not because it guarantees extraordinary returns. Not because it is free from risk. And certainly not because anyone can predict exactly what will happen next. The future has never offered certainty, and it never will. Instead, we've seen how silver sits at the intersection of some of the most powerful forces shaping the modern world: a changing monetary landscape, persistent debates over inflation and government debt, the decisions of the Federal Reserve, the strength of the US dollar, the rapid expansion of artificial intelligence, the race to build advanced semiconductor manufacturing, the global transition toward renewable energy, and the electrification of transportation. Each of these trends tells only part of the story, but together they explain why silver is no longer viewed as simply another commodity. It has become a reflection of broader economic transformation. That is why the world's largest investors spend so much time studying signals instead of headlines. They understand that markets rarely move because of one dramatic event. More often, they move because hundreds of small changes gradually reshape the financial landscape until, one day, the new direction becomes obvious to everyone. By then, the biggest moves are often already underway. History reminds us that the greatest investors were rarely those who predicted every market perfectly. They were the ones who remained patient, questioned popular assumptions, managed risk with discipline, and understood that preserving wealth is often just as important as creating it. Perhaps that is the most valuable lesson silver has to offer. It encourages investors to think beyond daily price movements, look past sensational headlines, and ask deeper questions about where the global economy is heading, not just next month, but over the next decade. Successful investing is not about chasing certainty. It is about making thoughtful decisions in a world where uncertainty is permanent. Silver's next chapter has not yet been written. It may benefit from accelerating industrial demand. It may respond to changing monetary conditions. It may experience periods of remarkable strength or extended consolidation. No one knows for certain, and responsible investors are willing to acknowledge that uncertainty rather than ignore it. What they can do is remain informed, study the evidence, understand the risks, recognize the opportunities, and continue adapting as the world changes. Because in the end, the most important investment is not a particular stock, a single commodity, or even silver itself. It is the ability to think independently when others are reacting emotionally, to remain patient when markets become noisy, and to focus on long-term trends instead of short-term distractions. The greatest fortunes in history were rarely built by following the crowd. They were built by those who recognized meaningful change before it became obvious. Perhaps silver will become one of the defining investment stories of the coming decade. Perhaps it won't. Only time will reveal the answer. But one thing is certain, the investors who consistently succeed are not those who believe they know the future. They are the ones who never stop preparing for it. And maybe, just maybe, the next great signal isn't the one making headlines today. It's the one quietly taking shape beneath the surface, waiting for the rest of the world to finally notice.